Well, good afternoon, everyone. Cynthia Tomei here with Interactive Brokers, and thank you for joining us today as we have a presentation delivered by McAlinden Research Partners. Now, McAlinden's team of industry professionals has extensive research and operational experience and is also led by a seasoned veteran. Now, a brief background on each of our presenters today. Joseph, or Joe McAlinden, is the Chief Investment Officer and has over 50 years of investment and research experience. He's a former CIO of Morgan Stanley Investment Management, a former CIO of Dillon & Read, as well as a former president and CEO of Argus Research. We also have with us Warren Hatch, who is a portfolio management and macroeconomic research with over 15 years of investment and research experience. He's a former portfolio manager and investment strategist at Morgan Stanley Investment Management. And then we also have with us today Rob Davis. Rob is business development with McAlinden Research Partners and has over 40 years of investment and research sales experience. He's a former business development managing director at Concept Capital and a former hedge fund services sales at Montgomery Prime Broker. Also has experience in equity sales at Morgan Stanley, Dillon Read, and Oppenheimer. So I'd like you all to join me here this afternoon in welcoming this team from McAlinden Research Partners. Now, I'm going to actually, I've moved this over to the slides for today, and I'm going to ask Rob Davis to unmute your phone, and let's get us started here this afternoon. Thanks for joining us, Rob. Would you unmute your phone? Okay, well, Rob, I can unmute the phone for you, so hang on. I'm simply going to unmute your line, and can you give us a quick hello?
Hi there. Can you hear me okay?
Excellent.
Yeah,
excellent.
sorry, it took me a moment.
Yes, I can. Thank you.
Okay, great. Okay, thanks everybody for joining us, and thank you so much, Cynthia, for that nice introduction. We're here to really talk about change-driven thematic investing, which is something that Joe McAlinden has developed an expertise in over his many, many years. At the very back of this presentation is a description of everybody's background who's involved in the firm, including Joe and Warren. And we're going to get very quickly into the presentation. I just want to set the scene by saying that our firm, which is McAlinden Research Partners, is an independent research company. We are focused on identifying investment themes through this process that we'll be describing. And with that, I'd like to introduce you to the founder and our leader, Joe McAlinden, who I met at Dillon Read actually in the late 80s, just after the crash of '87, and have gotten to know very well over the years, and now we are working together and having a very fascinating time in this age that we're in today. So with that, Joe, why don't you take the helm?
That over the 50 years that I've been in the business, I've learned a lot of things and then forgotten a lot of what I learned and remembered the most important ones. And I have to tell you that over the decades, I've been an analyst, I've been a research director, a portfolio manager, as CIO, a manager of portfolio managers. And the one thing that I observed throughout it all finally came to me after many years, which is that most of the great performance in portfolios or even in analyst picks comes from the correct identification of change that is really transformational and sets in motion an investment opportunity in a portfolio or for an individual analyst track record. We call it change-driven thematic investing. And it's frankly based on, in part, the ideas from the Austrian economist Joseph Schumpeter, who coined the phrase Schumpeterian destruction, which basically in his day, which was a long time ago, were things like canals being put out of business by the innovation of railroads and so on. Today we have unlimited numbers of discontinuities that are rattling the markets and the economies of the world, and that's where we focus our energy. Again, the reason we focus our energy there is that we believe that the market is generally efficient about digesting the daily flow of research that comes from the street and incremental information. But what we look for and what we've tried to train ourselves to be students of is when there's bona fide disruptive change that marks a radical break in the equilibrium. Now, what behavioral economists and financial guys have identified as a natural human tendency to reject new ideas, they have labeled status quo bias. And we rely on a degree of status quo bias when we focus on a new idea because we, of course, want to have an opportunity for ourselves and our investors to get on board with a new idea. And that basically is what our focus is and what we try to do. Now, let me walk you through a hypothetical example of how disruptive change can affect a security or a commodity or a currency. Things generally are in a state of equilibrium because there's so much coverage of everything, 24-hour news cycles, hundreds of analysts and portfolio people tracking events that go on around the world. And so things are recognized and digested, particularly when they are what we call incremental news or incremental change. And as I had said, what we tend to focus on is those shocks, those usually external shocks, although sometimes they can be from inside a big company that might change its business model or introduce some new idea that shakes up a whole industry. But generally, they are typically business cycle turning points, technological innovations, new regulations, sometimes political events, and as I said, new business models, and even natural events in the environment, such as things like tsunamis and hurricanes and volcanoes. And when these things occur, you tend to get a disruption that alters the status quo, but very often the experts, the scientists, the analysts, the economists don't want to recognize the change. And as a consequence, the securities or commodities or currency prices will tend to trade for a while, reflecting controversy and disagreement among the experts. And it's during that period, as you can see on the exhibit, sort of that triangle between the time of the disruption and the time where it's fully recognized in the market, where we seek to have opportunities to get in to a theme and get back out. And when we do that, we try not to pick the big winner within the theme. What we want to do is identify the theme and turn it over to other investment professionals, portfolio managers, and traders to express the theme as they choose, but our recommendation is usually to eliminate or minimize idiosyncratic risk by expressing the thematic trade as a basket. So that's the sweet spot that we shoot for, as you can see once again on the exhibit. But I would caution one last point, and that is that very often you get an overshoot where things go from being properly valued, then a disruption comes along, then there's an opportunity. And these are things, by the way, that are not like two-day trades. These are things that are 6, 9 months, sometimes 1 to 2 year opportunities. But very often they go beyond where they should go, and one thing I think we're sometimes guilty of is pulling back on the theme a little too early and not getting that last rise, but that's okay. Now you can turn the chart upside down, which I don't have an exhibit on, and express the very same idea as a short, but it would be a mirror reflection of what I've shown you here this afternoon. So with that, I want to turn now over to my partner and colleague Warren Hatch, who's going to give you some examples over the recent years of when disruptive change has hit and how it created a tremendous opportunity. Warren?
Yeah, hi, thanks, Joe. Yep, I'm working. This is our first round with this, so still working out the technology. It works pretty well. So I'm just going to go through 3 examples that we've pulled together that follow the template that Joe just described. There are many, many more, but these seem to be pretty good examples from the last few years. The first one here has to do with healthcare reform in the U.S. And whether you think it's a good thing, a bad thing, that sort of doesn't matter for investors, because what matters is, does it present any new opportunities? And healthcare reform certainly has, and here's one. And what this graphic is showing, it's from Gallup, is the percentage of U.S. adults who don't have health insurance. And it might be secular, it might be cyclical, but what was going on from 2009 through 2013 is an upward drift in uninsured Americans. Now, healthcare reform itself was passed in around 2010, but the provisions clicked in the following years. And the big one here clicked in with the healthcare exchanges at the end of 2013. And when that happened, there we go. The percentage of Americans without insurance dropped quite dramatically. And that is going to be a shift to the economics of assorted industries in the healthcare industry, and one in particular is the healthcare providers and services. This is the industry group that's tracked by the S&P 500. There's about 16 securities in there, and some of them have done better than others, but to go to Joe's point, the whole group has done really well as a result of this disruption that's added revenue to their bottom lines, and continues to do so far. There is certainly some uncertainty this year about what may happen with the healthcare law, but at least for the moment, it's been a quite dramatic move in this particular industry group. So that's one example. Let's go to another one, which is maybe even more dramatic, and this is Japan, where for years and years and years they were mired in a deflationary spiral, had assorted efforts to reform. None of them ever took root. And one way to depict that is this particular chart, which is showing the Bank of Japan's balance sheet. Just like the Fed has, the Bank of Japan has a balance sheet. And through all those years, it's had very slow upward drift, nothing very dramatic. But then at the end of 2012, there's new elections pending in Japan, and a new guy is on the scene, rising rapidly in the polls, Shinzo Abe, and gets elected with a big mandate to do very radical reforms on fiscal side, on the monetary side. And one of the first things that happens is he appoints a new governor at the Bank of Japan who promptly, rapidly expands the balance sheet at the Bank of Japan. That has all kinds of effects. It opens up the floodgates for stimulus into the economy and financial markets and currency markets, and creates new opportunities there. And one of them in particular is the yen. So here's the yen. You can see where Abe was elected in late 2012. The balance sheet expanded and the yen came down quite dramatically. You can see again in late 2014, where the yen sold off again, and that's where the Bank of Japan did another round of quantitative and qualitative easing, they call it, and the yen sold off again. And there's some discussion that they may do yet another round. And it wasn't just the yen that sold off, it was also stocks rallied sharply, almost an identical mirror image of it. The Nikkei has been roaring ever since and continues to do well, with some pretty dramatic pullbacks along the way, to be sure, but the overall picture is one of pretty strong performance in the Nikkei. And go to
Warren, I just have a question, just a quick question, Warren. So that play on the Nikkei, on both sides of that equation, came from government, you'd say from like the government actions that were taken after the election, and so pretty much can be taken just from those actions.
Well, that's certainly what started it, and it's Abe's famous 3 arrows, with the first being monetary stimulus, and then the second fiscal, and then the third is structural reform. And all of those things, when they're acting in concert, certainly get the financial markets moving, but to keep them going, there needs to be something happening on the ground. And so, for instance, with the yen being weaker, that's been a tremendous boon to exporters and their overseas profits. And that shows up with stronger earnings and helps lift the Nikkei. So there starts to be feedback effects along the way that may have been started by government policy, but there are other things that are keeping it going.
Great, good example.
And let's go to the last one here, which is a really big one. And actually, see, I can't quite figure out how to get the pointer going here. I forgot. Oh, there we go. So, yep. So this last one is the U.S. household sector and housing. And it had a pretty dramatic recovery a few years ago, but has been less dramatic more recently, although perhaps it's beginning to stir. And one of the things that has changed is this particular metric, household formations. And historically, we should have put in a long-term line. Historically, the average is right around here. So they've been running well below average for most of the cycle. And a lot of reasons for that. Job growth has been slow, particularly among younger age cohorts. So that's going to restrain household formation. But something happened last year. Job growth among younger Americans, while still slow, has turned up. And it's turned up pretty dramatically. And along with it, so too has household formation. And this is now running above average. This is data that comes out quarterly, but gets reported monthly. So we're going to get another 3 data points in the next few weeks to tell us whether this is a one-off surge or a clear inflection point in the data. The way we've been looking at it, we suspect that it's going to be a pretty strong inflection point. And the stock market seems to agree. Here is the Home Furnishings Index, again, an S&P index. And ever since that data started to come out, that index has done really well. That's because when new households are formed, people need carpeting, they need appliances, they need all of those things that go into the Home Furnishings Index. And that's been a pretty dramatic shift as well. You can see it was kind of flat, and then it's turned up, just like the schematic that Joe walked us through at the beginning. Now, we could go into more details if it helps, but that kind of hopefully gives the idea. And I can see that we did have one question, and maybe Joe can pick up on it. One question so far about drones, and can it be described as an emerging innovative sector, and what is its potential? And maybe I'll set up Joe and say it absolutely is a strong a strong emerging trend. It's going to have a lot of implications in the future years. It's going to disrupt a lot of businesses. And it's also perhaps part of a broader trend toward autonomous vehicles. So drones are in the air, but there'll also be autonomous cars on the ground. They're already beginning to show up in some of the higher-end luxury cars that self-park and things like that. And then also out on the mining pits where the big trucks and loaders are now completely autonomous. So that whole broader technology is going to disrupt a lot of stuff, and it's going to be really interesting. A lot of opportunities come out of that. And with that, maybe I'll pass it back to Joe to put that in context.
Warren, you're absolutely right. The drones story is part of a bigger picture of, let's call it intelligent, semi-intelligent robotics. We've been watching this very carefully. There obviously would be a play in drones, for example, or in robotics on the companies that build these things, and it's something we have looked at and we're tracking, and there may be a point where we become table-pounding positive on those equities as a theme, but that's not the case at the moment. We are looking actually more intensively at the consequences of the proliferation of drones in the military and policing and security, and as most of you I'm sure are aware, given Amazon's recent efforts in delivery of merchandise, residentially and even commercially. And so the disruption caused by this trend of airborne robotics or ground-based robotic devices, or in the warehouse devices or in the factory devices, are going to be huge, starting at the macro level where it is a factor. We have to say, and I don't want to sound like a Luddite here, but it is a factor in the absence of wage growth in recent years, and it's probably going to be a continued challenge for average workers going forward. Not that we don't think there's going to be a pickup in wage growth. We actually think the next couple of years is going to see a strong surge. But on a secular basis, the drones and the robotics raise the question of exactly what the implications of this are for the labor share of the pie. Again, it's a great question. It is exactly the kind of disruptive change that we look for, like the advent of the internet. But I would caution that sometimes the obvious initial plays are not the right plays. Somebody said once to me that the first pioneers tend to die of plague and arrows in their backs, and that's the second and third wave that actually gets the ponderosa. So, and I think we've seen that in the evolution of the internet and other things. With that, let me throw it back to Warren for a little bit more on this subject.
Yeah, and we're already seeing some industries get nervous about the broader implications. Insurance, for instance, some companies have already issued in their quarterly earnings statements long-term warnings about how fewer accidents are going to be impacting their business in pretty dramatic ways. It's also going to be boosting productivity. It's going to give a lot more leisure time. It's going to be all kinds of knock-on effects that are probably too far distant on the horizon right now to be investable, but certainly are worth exploring to be prepared for when that moment arrives, because it may arrive much faster than it appeared even a year or two ago. So a follow-up is to name a few companies in the sector. We do have a spreadsheet where we've been tracking some of those things. I don't have it in my fingertips. I apologize for that, but it's certainly something we could share in due course. Just get in touch with any of us or Rob or anything like that, and we can get that. To anyone who's interested on following up on any of these examples we've given, or the drones or anything else that's going to come up now. And
yes, we certainly do that. We certainly do that with our subscribers, and we'll put together a basket and make it very clear where to fish, so to speak, which pond to be fishing in, to find that. And or at times we will put together our own basket, or we'll refer people to an ETF that might be appropriate for that purpose. If that's all the questions,
well,
Cynthia.
Bob, Cynthia here, because you just mentioned a very important point that I wanted to show everyone. Your subscription-based service. Now, McAlinden has been added to the TWS Research platform, and what I've done, I've just grabbed the ball back because I did want to show our participants where they can find out some additional information. Now, I am going to share my screen with you momentarily. You're going to see your what you'll see is your screen will blank now, and you'll be transported directly to my desktop. Now, I'm already in our account management feature. If you access account management from within, you can go to the Manage Account section. Now, all IB account holders get access to account management. Once you've logged in, notice you can go to the Manage Account section and Trade Configuration, where you'll find information out about our research platforms. Once you're on this page, simply scroll down. Notice as you scroll down, we're getting into the analyst research, and what you can find here is MRP. And notice that many of these research products also have a free trial, so you can join and take a look at the research that's provided. Now, I also did want to show you in Trader Workstation where you can locate that information. Now, you'll see here, if we do go to the Analyst Research tab, it is not listed here. Now, that happens to be because rather than individual ticker research, McAlinden does put out a classified newswire that includes daily intelligence briefings. So rather than going through the drop-down box here, I'm going to take you down into the newswire section where you can pull up all of those daily reports once you have subscribed. Now notice in the news section, what you can do is simply add a new tab. I've already added and renamed that tab to show MRP. Now notice when I do come into this screen, well, first of all, when you have added a new tab, the first thing you're going to want to do is go into the configuration branch and choose those settings, because you'll notice once you do add a new tab on that page, it will come in as the general news. From here, you'll find that all of the services you subscribe to will be selected, and you can simply choose to deselect all and then find McAlinden Research Partners and simply click OK, or click Apply and then OK. That will actually create this separate tab where you can find any of those daily intelligence briefings. Now notice here, simply clicking on any of these, I think let's go in to luxury car makers. I'll pull that one up right now, and notice how you can view that daily intelligence briefing. There's quite a bit of information that's provided on this page, and all of this is available through that Trader Workstation subscription. So I did want to mention that to everyone else here. Now also what I am going to do is I'm going to stop my desktop share and take you back into the main event window. Now, if there are any additional questions, now is a good time to put them into the chat panel. But also, I do have one piece of business that I need to run in each of our events, and that's to elicit some feedback from each of our participants here. Notice that I'm going to open up a polling panel with 3 short questions on it. You can simply, what I do ask is that you make your selections here, and 2 of those questions are multiple choice, so I do try and keep it easy. But also, if there's something you'd like to see or listen to have covered in these webinars, notice number 2 has an input field. It's a great place to put those comments or suggestions on other topics. And then make sure that you do click the submit button. Now, by the way, don't put any of your questions for our MRP team there. They won't see those because I won't get access to the questions until later on today. So I do want to ask everyone, please click that submit button now. Poll did end, and I want to thank all of you for that feedback. It is very helpful. Now, any additional questions that you may have, let's go back to the chat panel, and please enter them into the chat panel at this point. And I'd also, before we do exit today's session, I want to thank everyone for your feedback there. And by the way, I also want to thank each of our presenters here today. I definitely appreciate the topics that Rob, Warren, and Joseph have been talking about today. So with that, it looks like I'm not seeing any additional questions. I'm not sure if any of our panelists have either. But I do want to remind you that McAlinden Research Partners is an investment strategy firm whose mission is in identifying investment themes early in their unfolding. Those daily intelligent briefings are MRP's reports with news and data that highlight the important changes that are happening around the world and that may lead to a new investment opportunity. So please check out those research papers available through TWS. Let me see, I think, oh, there is another question. Oh, hello, Kisraj, has about climate change. Would one of you like to handle that question?
I'm sure. I think that's a good one for Warren to handle. Thank you, Cynthia.
Oh, okay. Excellent. Warren, are you still with us?
I am, absolutely. And
if that panel is in your way, you can double-click the chat panel at the top of the screen where you can view that question. You may not be seeing it.
I see it now. And the question is regarding climate change and its effect on world economies, such as drought in California, and responses by companies. This is we haven't focused tremendously on climate change per se, but we certainly have focused on instances where there have been abrupt changes in the climate in different regions around the world, including California, where drought is affecting a lot of industries, notably agriculture, is going to impair the export of a lot of water-intensive crops this year, and will do so in future years if it doesn't abate. We've done some work on that. Another example where it's been a tremendous impact is Brazil. And Brazil has had a really difficult time. They've got a lot of problems going on at the moment. One of them is that they depend to an extraordinary extent on hydroelectric power, but so many of the reservoirs are now low or dry that they have to import more expensive power from neighboring countries. They have blackouts, and it's impacting their own manufacturing exports. So what was already a bad situation has become worse, certainly for Brazil. So we look at examples like that, more discrete investable examples on how we can put together some sort of a basket of securities that have direct exposure to an identifiable example like that. There's certainly broader trends unfolding as well, but the horizon for in most cases tends to be a little bit longer than we focus on, over multiple years instead of 6 months to a couple of years typically. But again, we're happy to share what we've got on related ideas on climate and weather.
Warren, let me just add to that wherever you stand on this issue, there's no doubt that there is climate change that goes on throughout history. There is climate change going on now. The debate goes on in some places about whether it's man-caused or not. But most policymakers, what's important for us is that most policymakers in most countries have come to the conclusion that it is man-caused, man-made, and therefore they're adopting measures that are intended to minimize carbon emissions. And that has implications for the coal industry, which we have done a fair amount of research on, and obviously solar and alternative energy. And at the moment, this is not a new story, however. It's not the kind of transformational sudden shock that we would typically look for. But I'll tell you one thing we're watching very closely is that, having been skeptical about solar, for example, and other forms of alternative electrical generation for a long time, it appears that solar, not wind and other things, but solar, the costs are definitely falling rapidly. And this is something we're watching very closely, because if we were going to put a theme on in that area, we would want it to be based not just on public policy and subsidies, which, as we've seen in the last few years, can get turned on like a water faucet and then get turned off pretty quickly when they run out of money, the governments, when they run out of money. But this may become something that's economically viable in the next couple of years, and probably would be I think the #1 thematic play, but I don't think we're there yet. Warren, sorry for interrupting. I think you were wrapped up in any event.
Oh, yeah, I just wanted to, Warren, I wanted to just add one thing to that. This is Rob, which is that on the daily intelligence briefing, which was mentioned that is our vehicle for conveying information to our clients. There's also what we call a macro monitor, and the macro monitor is a tremendous source of information on all commodity prices, currencies, and many other bits of information that go into our calculation as to whether something is a potential theme, a way of spotting turning points, inflection points. And it's quite fascinating to look at what's happened to commodity prices over the last recent 6 months, 12 months, 5 years, and see where they've gone and spot changes. And of course, the climate affects many of those things. And that's right on the front page of our daily intelligence briefing, along with the country monitor, which follows 32 countries, and the sector monitor, which looks at the 10 sectors of the S&P and provides charts and information on each of those things, which are updated on a regular basis. Not that in any given day it's going to come up with some great idea, but over time and looking at it, it's one of the places that we get our input for what we think, may be a great new investable theme. Okay, sorry, Warren, go ahead.
Oh, well, that reminds me, that was just one more data point on the climate issue that was in today's DIBS. We call it DIBS, Daily Intelligence Briefing. It's our shorthand. But it has to do with farmers, and farm incomes in the United States have been quite a bit softer in the last few years as commodity prices have come down. And as a result, they're spending less on farming equipment and things like that. But they're also spending less on the more expensive seeds, new seeds that are available, and they're relying on older technology. And the climate risk is, if it's really wet or it's really hot, they will have planted crops with less resilient seeds, and the risk of crop failure of up to 20%, according to one expert, is pretty high because of their use of less resilient seeds. So if it is a long, hot summer, as it was a few years ago, the impact this year could be quite a bit more severe than it was a few years ago. Of course, that's kind of forecasting on a forecast. We'll wait to see what the weather does before doing anything, but it's something to be watching for.
Now, that bit of information that Warren just shared with you actually came from a different section of the daily intelligence briefing, which is contains articles that we have pulled from many sources of news in the last 24 hours on interesting things that we're seeing happen. And every day there's a focus on something that we're really zeroing in on to get a handle on what's happening there. And so when Cynthia showed you the list of various dibs and the subjects of each one, what that subject refers to is that on that day we saw a lot of information on that subject, and we pulled that information together into to see everything we could learn about it, and we pushed that out to our clients so that they can also learn about what's happening in that area. And it could be cars, it could be Japan, it could be almost any subject that rises to a level where we think, wow, that's something we have to really take a look at. So all that is delivered through that report.
Well, and we got another question popped up, and one that I think is also a really good one, which is, what about Greece? Is it still a problem for the world economy? And I'll kick off and then pass over back to Joe. But the answer is yes, but less than it was. So the risk of Greece, I think, a few years ago was, oh my goodness, here's a Eurozone member country, it's going under. If it leaves, the entire Eurozone will be at risk. And so they did everything they could to prevent that from happening, because of the spillover risk into other countries was so grave, it seemed at the time. Fast forward now, and the risk of Greece being ejected from the Eurozone returned, but the direct spillover effects on other countries are much less severe, directly at any rate, because the borrowing costs for Italy, for Spain in particular, and Ireland are not the same as Greece. So that correlation for those weaker countries has broken, and Greece now stands alone. Now, there's still the precedent that Greece could set if it is ejected, and that seems to have been a precedent that most policymakers in Europe decided not to set in February during the most recent flare-up of all of this. And it looks like they made a decision to figure something out, at least for the course of the next half year or year, to supply Greece what it needs. And what we're seeing now is a lot of brinksmanship about who's going to do what and who's going to blink first, and Greece kind of did a half blink and Germany did a half blink. And there's still a possibility that it goes wrong. The word I saw that was great. So there's Grexit, the risk that Greece exits, but that's maybe not so grave as a Grexident, that it just happens because of happenstance rather than by design. That seems to be a risk. It is real, but it's maybe, 5% risk of something bad like that happening rather than 20 or 30% risk of Greece being ejected from the Eurozone earlier in the year. So not out of the woods, but nowhere near as grave as it used to be, and the spill-on effects are much reduced, I think, is kind of the way we look at it. And as a result, you can make a good case that that's been one of the drivers for Europe's stock market's outperformance, is removing that uncertainty that much has helped spur the rally there. What would you think, Joe?
Sorry, I was on mute. I agree with everything you said, Warren. The only thing I would add is to segue into the broader issue of the type of debt, where there's lots of similar situations in the emerging markets, and in particular the impact of the dollar surge in the last, especially the last year, but over the last several years. And many countries have in recent years in the emerging markets category have issued bonds and borrowed money in bank loans and in dollar type denominations. And this means that now with this huge move in the dollar's exchange rate, and looking at it from the other side of the mirror, the fall in the exchange rate of so many of these countries, which has been disproportionate to the fall in the euro. You have a potentially gnarly situation that I'm not seeing as much news coverage of that as we are of the situation in Greece. And it's funny how the media tends to grab a hold of something and just beat it to death as the thing. You see this in murders and kidnappings and whatever, environmental events. And Greece is the issue of the moment. I remember being on a television interview 2 years ago when Malta was the issue of the moment, and all the experts were saying it was going to drag down the whole financial world. Many of them were, and it's kind of, now it's finally disappeared. But I think a bona fide issue is how are these emerging market countries that have issued dollar-based debt going to handle their interest payments and debt repayments, unless we get a complete reversal of the dollar and get it very rapidly. There could be a 1997-98 type of market event looming ahead of us. We're not saying that. It's not one of our themes at the moment, but it's something that we have under very close scrutiny. So sorry to digress from the Greece story, but I think that this EMD story is potentially actually much bigger.
I do want to also add, as it relates to Greece, however, that if you are able to look back into our DIBS reports that are on your system, on February 2nd, we did have a focus on Greece in that report, and it was at that time that Warren did recommend to go along Europe. So that was a case in point where, as I said, not every day. We don't come up with something great every day, but on that particular day, studying the situation in Greece, we did make that call. So Warren gets a shout out for that one. So is there anything else, Cynthia, that you feel that...
Well, there is one more question that came in on the U.S. economy. Can you see that, Rob?
Okay. Let me see here. Yes.
I can, and I'll read it. The U.S. economy is doing well. The yen and the euro have been devalued against the U.S. dollar. What is the effect of all that on the U.S. economy? Which dovetails, maybe Joe, you want to, because you've got some thoughts on that.
Yeah, well,
exploring the other day.
Sure, there are many effects. The obvious ones being a reduced level of competitiveness for products that are made here and exported to countries around the world. But that is not the same kind of impact on the U.S. When you have the currency getting too strong as it would be, say, for Germany or Japan, where trade as a percentage of total GDP is much higher. Ours is one of the lowest among the developed countries. So it's a factor. It's been somewhat, I think, priced in to the securities of some of the big capital goods companies, and it's something to pay attention to. But the issue does go beyond that, and it affects earnings, not just of exporters, but of global companies, multinationals, even if they have domestically produced products and services in Europe and Asia. When they finally report their earnings, which is a topical point, I would say, for the next several weeks, many of them are going to be slammed by something that we used to call the currency translation effect, where sales and earnings, the income statement items, as they get converted into the current value of the dollar, and you're looking at year-over-year comparisons where the dollar against a given currency might be up 25% unless the company had the prescience to fully hedge out its income statement risk, which not all companies do, there's going to be a big hit that you're going to be reading about, which I think is going to be a headwind for the stock market over the next 2 quarters. And the last point I would make about it is that even when you have companies that are domestically positioned and don't export very much, to the extent that they make things or provide services that are also made and provided in the world economy, there is the risk of import substitution for some of them. So that you might have a company in the Midwest that makes widgets and it doesn't export a single one in a given year, but maybe Japan or Italy produces that same widget, and now all of a sudden it's going to be coming in as an import and competing with the domestic manufacturer and knocking or limiting the pricing power of the domestic manufacturer. So there are a lot of ramifications to this, which we are studying and factoring into our broad view of what's going on with asset classes. Warren, you have anything to add?
No, that was great.
So all these questions are great questions, and they all come back to being able to look at some kind of very major change that is happening right now, not what's being predicted, but actually what's happening right now and what it could mean for some group of securities. And that is really the essence of thematic investing, the way that MRP looks at it. And as I mentioned, every day in that report, that Daily Intelligence Briefing, there's a subject which is focused on that's come out of the news in literally the last 24 hours that looks like, wow, we really want to get up to speed on that subject. Let's look at that subject in depth. And you can look through those and you can see each day what it was that we focused on. And if you read one of those, you'll get a tremendous idea on about and a tremendous update. Just the other day, we did a focus on Iran, and wow, it was just it was so interesting, and there are so many potential things that might come out of the development with Iran, with if everything goes through and holds in terms of what it would mean. And the report that we sent out gave people a great full understanding of all the issues, where it stands today. And while we didn't, make a specific recommendation because of it, we set the scene for when we get real conviction. We set the scene for that as to why we actually go for it if we do. And Warren, you might want to expand on that just a little bit.
Sure. Yeah. So it's a lot of indirect effects again, where there's some obvious things that will, assuming again that this agreement gets concluded and sanctions in fact are lifted. They've had massive underinvestment in energy infrastructure, so that's going to be a huge game changer for someone. That someone may end up being the European energy companies, because the EU's sanctions are relatively simple. They just put on a few layers, whereas in the U.S. there are many, many layers dating back decades, and it may take longer to lift them all. So the European companies may do better there. But one place where U.S. companies might do well is in pharmaceuticals, because there have been some exemptions to the export of humanitarian goods like medicines. So there are 50 companies that have already had waivers to operate in Iran, and they're well positioned to expand their business there and see a big boost to their revenues. So there are a few examples like that. Another one, a third one, two more. So banking is They're tremendously underserved. Very few people have credit cards, but they have very low debt. The country is bankrupt, but households are not. And so banking is going to be booming. One last one is consumer goods. Because of the sanctions, Iranian consumers have had limited access to global consumer goods. Virtually nothing from Europe, nothing from the U.S. Instead, they've been getting relatively lower quality goods from China and from India. That's going to shift. They're going to stop buying that stuff in preference for the higher quality, maybe more on the luxury end for European and North American consumer goods. So those are just a few examples of things that may unfold. Again, because it hasn't actually happened yet, we're not making recommendations yet, but we can sort of see what the terrain looks like if they are.
Yeah, and one last example that comes to mind is what happened when Russia made its move in Crimea. And that was a fascinating time, and there were a number of things that came out of that. Warren, maybe we'll conclude, unless there are any other questions, just conclude with a couple of the results of Mr. Putin's actions.
Yeah, so that's one that is still unfolding, but there were some things that were definitely going to happen pretty quickly, we thought, when Russia annexed Crimea and sanctions were imposed on Russia. And we went through, just kind of did with Iran, did something similar for Russia and did make some concrete recommendations as a result. One of them was to short European banks because of their exposure to Ukrainian debt, of all things. They held an awful lot of it, and Ukraine was not going to be able to make those debt payments, which turned out to be the case. As well as the sanctions were applied, a lot of European banks lost revenue as a result. So we recommended shorting European banks because of that. On the other hand, what happened, and is still happening, has caused a lot of policymakers in Europe to rethink their defense spending policies, which had been drifting down for decades. And at this point, that seems to have bottomed and is beginning to reverse. Some countries like Sweden are already setting the pace and speeding up defense spending. Others like Germany are slower to move, but are clearly moving in that direction. And so aerospace and defense, as a result of what Russia has been involved in eastern Ukraine and Crimea, is changing the game. That also fits into more of a global theme, but what happened right there definitely moved the dial in a material way.
How about on the currency side, Warren?
Then on the currency side, so we figured anything related to Russia was going to be toxic and should be shorted. And that was true for the equities, true for the bonds, and true for the currency. And that is what happened pretty rapidly, particularly as more sanctions were applied. And then what happened there is there were other disruptions in the global economy, in part sparked or reinforced by those events, including the big drop in oil. And this is a point Joe was making months ago, and is not getting enough coverage, I think. And that is in the summer, last summer, when that airliner was shot down, Europe seems to have made a decision to stand much more firmly against what Russia was doing than they had, even if it meant that their own economies would suffer as a result. And that's what happened. They put on sanctions, deep sanctions. Russia put on their counter sanctions to prohibit the importation of European goods. That affected quite quickly German industrial production. And if manufacturing in Europe is slower, their use of energy is lower, and surely that's one of the reasons for oil prices to have gone into the slump that they did. There are certainly more factors at work, but that is certainly one of them. And so by annexing Crimea, Putin in part set in motion the decline in crude oil that added to Russia's own woes and reinforced the precipitous drop in the currency through just until a few months ago. Now that oil prices are beginning to firm up, or at least stop falling, the ruble has begun to strengthen, but it's still way down from where it was. And the damage done to Russia's economy is going to be years to reverse. Even if sanctions on Russia were lifted today, the damage would be quite some time to heal, because a lot of companies that had capital spending projects there aren't going to be rushing back in to restart them again. So Russia's looking at a long-term tough times, but the short on the ruble, to go back to where Rob started us, is probably done.
So that's some examples from the past. Past is, of course, prologue. There'll be many more things happening, and maybe Iran will be the cause of some new ideas to come along pretty soon. But it's always a boiling pot, and we're always looking for where the opportunities are. So please take a look at our MRP reports. As Cynthia said, it's easy to sign up and get a trial. And if anybody has any questions, our information, Cynthia, I assume, is available, so people could reach out if they have any questions. And we look forward to chatting with you further.
Okay, well, thank you so much, Rob. And I want to thank all of the gentlemen from MRP today for our presentation. Some excellent insights. And also, I want to mention as well to check out the MRP offerings available through Trader Workstation. Well, that is going to conclude today's informational webinar. Oh, and Kizraj, thanks. Also appreciates the input here today. So we are going to conclude today's session. Now, I do want to remind all of the participants as well that we have been recording today's event. So if you'd like to come back and review some of these concepts, simply watch your email. Hopefully I'll get the recording out to each of you in the next hour or so. So we are going to end today's session. Thank you all very much for your participation. Have a great day, everyone. And please remember to trade smart. Thanks. By the way, you can all exit the session using the X in the upper right-hand corner, and be on the lookout for today's webinar notes that will also appear in a new browser window once you do leave today's event. So thanks once again, and have a great day, everyone. Thanks.
You too, Cynthia. Take care.